So this is where the most fun part of the lecture, I think, is estimations. And this is where it gets a little interesting and a little fun because we have to kind of guess, right? That's what an estimate is it's an educated guess. So we know there's an obligation, but we don't know the amount. But we can reasonably estimate it. And so there's a lot of different times where we know that we're going to owe money in the future, but we just don't know how much. This might be for lawsuits. This might be for PTO vacations. This might be for variable bonuses, or it could be for like pension benefits. Pension benefits are really complex. There's a whole accounting. You can become a pension benefit expert, right? They're very, very complex. But I'm just going to go high level of like, hey, these are estimates, and this is something that we can consider. So if we promise benefits in the future to our employees, give me a second, I'm talking a lot. If we consider benefits for employees in the future, we don't know how much they're going to use, right? Like if I hire Madiha for my company, she works for me for 30 years, and I say, if you work for me for 30 years, I'll pay for your health the rest of your life. I don't know how long she'll live. She could live to 150, or who knows if she'll even make it past. So, well, you don't know, right? Like there's no definition on life. There's people's jobs who kind of quantify that estimate. We don't know how if she'll be healthy. Maybe she'll have no sickness her whole life, or maybe she'll be very sick. We have no clue about how much these costs are. So we have to make educated estimates, which we'd get from what are called actuaries. Actuaries are accountants who have become statistical experts in these areas of estimation. And they normally work for insurance companies because that's how insurance companies make money. So assume an employer agrees to pay an amount for medical insurance equal to $8,000 and contribute an additional 10% to a retirement program. So in this case, it's relatively straightforward. We're saying that we contribute an extra $8,000 plus 10% of an employee's to a retirement program. And so we'd have a benefit expense of $20,000. That's the $8,000 plus the $12,000, which is $120,000 times 10%. And then we're saying 8,000 goes to medical insurance, 12,000 goes to retirement. These would be liabilities, right? $8,000 would be the medical insurance liability. The 12,000 would be the retirement program liability. And we're just estimating that's going to be the cost. What about PTO, like vacation benefits? I get PTO, but maybe I don't use it. Maybe they get 2 paid vacation benefits a year, but maybe it's use it or lose it, or maybe a lot of employees don't use their vacation. They get caught up in work. So it's an estimate, right? We're going to assume that they're going to use their 2 weeks of vacation. And so we can either assume a 50-week year or a 52-week year, and then we determine a weekly benefit amount, and we'll allocate that amount to each month. It doesn't mean they're using that amount every month, right? It just means that we're estimating that they're going to use it every month, because we can't really know what they're going to use until they use it. But by the matching principle, we're supposed to be matching it to the period where the employee is working. And so that's where the complexity is.
Professor, I have a question about vacation benefits.
Yep.
Right. So you mentioned that there's a case in which a company, I don't know, probably somewhere in the contract, it's like you use your vacation or you just don't get it at all. Like you use it within a year or you just don't have it.
Yep.
So how would you, I guess, like what kind of entry would you put in if they just don't use their vacation?
You'd have to adjust the estimate at the end of the year. So it's a good question. So
thank you.
Yeah, excellent question. So let's say, give me 1 second. So let's say we have an employee who makes $100,000 a year, and they have a $10,000 vacation benefit, and for the amount of time they get off. I'm just going to use dollars instead of time because it's easier. But they can use it or lose it every year. If they don't use it, it doesn't grow. And so let's say we just take that evenly, or let's say it's $12,000 in benefit. So every month we're going to give him $1,000 benefit. Let's say at the end of the year, he's only used $6,000 of that benefit. That's $6,000. Even we've accrued for $12,000, right? So we've debited vacation expense $12,000, credited vacation payable $12,000. Then we've done our adjustment. When we've done the payable, we debited payable $6,000, credited our cash $6,000. We have 6,000 left over, and we just have to reverse it, right? We would reduce our expense and reduce our payable at the end. We'd have to adjust our benefits, similar to how we did our account receivable estimates. Remember when we did allowance for doubtful accounts? It's very similar.
Okay, thank you.
No problem. And that's where this estimation accounting gets really interesting and complex. So great question. Same thing in bonuses. What if a lot of bonus plans are discretionary. Almost every bonus plan is discretionary, which means that the boss says, we're going to pay you 15% bonus or 10% bonus at the end of the year. But if something goes wrong, we can change that amount. Like, this is our plan, but we always retain the right to change the amount. And most companies aren't going to not change the amount, right? They're going to promise, they're not going to promise it 100%. Every company is going to retain their right to not pay a bonus if they can, unless you're an executive. And so in this case, assume the bonus will be $10,000 will be paid to an employee and shared by all. So we're giving $10,000 to employees. We're going to debit the bonus expense $10,000 when we say we're going to do the bonus, and then credit the payable $10,000. Even if we might not wind up paying the bonus, this is just when we're estimating when the bonuses will be paid. And then that amount might need to be adjusted up or down once we actually pay the bonuses. What about warranty liabilities? Sometimes, like when we buy a fridge or if you buy a TV, you get a 3-year warranty. Or if something goes wrong, they'll go fix it. Same thing, cars you can buy a warranty for, right? Where your engine breaks down, they'll fix the engine for the first 5 to 10 years. Company offering the warranty will have to assume that as a liability. So here they're saying a 12,000 car royal warranty for a $16,000 car. What we would do, we don't know how many cars are going to break down. We don't know how much those parts are going to be. So we have to make a reasonable estimate based off past experience. And so you're not going to have to determine that for this class, but if you were to work for a company, I'd look at how much has the warranty cost been over the last few years of the business, and I'd make an estimation based off the price for that car. So here they're saying it's 4% of the car selling price. So on the day we sell the car, we'd have a warranty expense of $640 and credit a warranty liability of $640. And if the car is returned for repairs, we reduce the liability and reduce the inventory. And this just goes over some of the math here, right? So we can go through these. A company's salaried employees earn 2 weeks of vacation per year. It pays $208,000 in employee salaries for 52 weeks, but its employee only works 50 weeks. This means the total weekly expense is $4,160 instead of $4,000 cash paid weekly to employees. Record the company's weekly vacation benefits expense. We're saying that 4,160 minus the 4,000 of cash actually paid is our weekly vacation benefits expense, and then we're going to have a benefit payable of 160. Same here. I don't want to read these to you if they're simple. Like, you get the bonus. We're saying we're going to pay out a $40,000 bonus. That's our guess. So we're going to make it debit bonus expense $40,000, payout bonus payable. And when we pay it out, we pay cash. If there's an adjustment, we'll adjust it. The main point here is when we believe that we're going to make the bonus payment, we don't wait until the bonus payment occurs. It's once we've announced that we're going to make the payment, right? That's when we have to have a payable. If I promise my employees a 15% bonus, and that's what I expect to pay them, I'm going to accrue it when they've earned it, not when they receive the cash. That's the whole point of accrual-based accounting, based on that expense recognition and matching principle. And same thing with the warranty principle, right? We can do, the math is basic. The main point is we're going to accrue a warranty liability upon the sale of the car. And then if the warranty liability is used, then we reduce it when it's used. Just no disclaimer, the new accounting rules also say that there might be some revenue recognized related to that warranty also. But I'm not going to go into that detail here, but we can go into it in another class, or you'll go into it in the future more complex accounting courses. Okay, any questions here?
I have a question.
Yeah.
So, how do companies incur taxes for contractors who work overseas? Does that make
Okay,
sense?
yeah, so that's a good question. And so that's actually, I'd say, beyond the scope of this course, well beyond. But what you would be doing is you'd have to engage a tax professional and determine that there's a lot of complexities. Like if it's someone working overseas, have they worked in the U.S. at all? Do you have a U.S. based business, and what is the amount of effort that you're putting? Do you have any overseas portion? Then they might have some kind of U.S. Your business will have a U.S. obligation, and then that employee, that person, depending on certain classifications and what country it is, might also have a U.S. tax obligation, but they might not. And it really depends on the country. It depends on your business, but there's very complex tax laws, especially just in the U.S. alone. But once you go to international tax law, you really need an international tax law expert. And so I've taken 2 advanced tax law classes, and there's people you can go get an advanced law degree and be like an attorney of tax law, and that's kind of the level of education you'd need, where these laws are constantly changing. So I hope that answers. There are considerations around it. If it's a small amount, I wouldn't be worried. Like if it's under $10,000, I don't think anyone's going to freak out about it. Um, but you should still do it correctly. But if you're talking about large amounts of money, you're going to need a tax expert to look into it. Does that make sense?
Yeah, thank you.
No, of course. Great question. Yeah, and that's kind of the going to be the answer for all of these uh, questions as you learn more about accounting. Is it really depends, and you'll find that tax law and like even these accounting rules we're talking about, they're changing. Like they're constantly evolving and growing, and tax laws changed multiple times in the last few years. So uh, at a certain point, the real facts and circumstances really will drive the determination. But great questions. Keep them. Any other questions? Keep them coming. Let's see. Our taxes. I have a question from someone. Are taxes that are taken from an employee's paycheck based on the amount they earn, and after they are taken, amount they receive based on what we set aside. Okay. So yeah. So paychecks are based on what are based on your withholding. So these answers aren't going to be easy. I'm just going to give you the real answer. What is taken from your paycheck is based off paycheck withholdings. It's called the W-4 form, where you attest to how much you think should be withheld from your paycheck, and they do a calculation. So you can look at the IRS W-4 form. That isn't necessarily what you owe, right? The tax laws, the way that tax law works right now, is it's on the onus of the individual to state how much that they would owe and withhold from each paycheck. The employer will withhold it from every paycheck. Then yearly, you will file a federal tax return and a state tax return where you determine how much you actually owe. And those amounts should be reasonably close. If you misrepresented the information on your withholdings form, then you may pay a large penalty. If you overestimated, you get a tax refund, and that's where you hear about tax refunds. And so after that amount is taken out, then you have whatever's left for yourself, and that's on a graded system. So like under a certain amount of money, I don't know they change the thresholds every year, but under $40,000 you may not pay any taxes, or under 20,000 you might not pay any taxes, and 20,000 to 40,000 you might pay 10%, 40,000 to 80,000 you might pay 20%, and so on and so forth, as in a graded system where you pay specific tax rates for those amounts. And the second question is multi-period liabilities. What happens if the liability becomes washed? Like what happens if you have deferred revenue with a company and then that company goes under? These are estimates, so we always revise our estimates. So if I received cash from a company to perform services for that company, that company goes bankrupt and I no longer need to perform those services, I can recognize that revenue. If I owe the money to the company, if they go bankrupt, then I have to give that money back, right? And then so these are estimates. We're always going to revise them for the truth of what happens. Does that answer your question? Is this making sense? Cool. Okay. Any other questions? We'll keep going then. So now we're going to talk about contingent liabilities. I'm really going to structure this in the concept of like legal cases. So by legal cases or lawsuits, you can think of that most companies are going to get sued. When you get to a certain size, someone's going to try to sue the company, either for intellectual property rights, either because of a disgruntled employee, maybe an owner doesn't like what's happening. And so the company is going to most definitely face a lawsuit. So we have these questions of lawsuits are very complex, right? This is what we call a contingent liability. It means something in the future might trigger us owing a liability. That's what contingent means. It means it's based on a future event, right? And so we don't know, like, let's say I own a business and someone comes up to me and says, hey, I think that I own Coombs Inc. and you own Coombs Company, and we think that you're infringing on our right of Coombs Inc. and stealing our customers. We're going to sue you. On day one, I don't know if that's a reasonable lawsuit. Maybe they just want some of my money. And I don't know if they'll win it or not. So this is a contingent liability. Like, hey, maybe I'll owe these people money. Maybe I did something wrong, but I don't know. And so we have to determine, what is the future event? Is it probable? Probable means like, is there a 90% like a 75 to 90% likelihood of this happening? Like a very strong likelihood. Those percentage changes. Is it possible? Is it like 25 to 75% likelihood? Or is it remote? Is this absurd? Like, hey, my last name's Coombs. You can't sue me for having a last name, right? So in that consideration, if it's remote, I'm not going to disclose it. I'll do an assessment and write somewhere like, hey, this is absurd. And I'll have a legal opinion. Like maybe an attorney will say, yeah, you're fine. Don't worry. That's your name. But maybe it turns out my last name isn't Coombs. Maybe I changed it because I wanted to maybe I thought it was a more strong name. Maybe it's a possible future event. If it's this possible, I don't have to estimate the amount. I can just disclose it in my notes. But what if they find out that, hey, my name's actually something Stevenson, and I found out there was another accounting firm in the area named Coombs, and I changed my name to Coombs in order to try to steal some of their customers. And it turns out I've done something completely wrong. Then the future event is probably probable, right? Like, hey, I definitely did something wrong. The question now is, how much am I going to owe? And so I'd go to an attorney and I would ask them, what is the estimated amount of this future lawsuit or settlement? If we can't estimate it, we disclose it in the notes. We'd say, hey, we're getting sued. We probably owe the money, but we can't estimate the amount. We put that on the financial statement. Let all the investors know this is what's happening. If we can't estimate the amount, then we record it as a liability on our books, like lawsuit liability or pending lawsuits, and then we debit the expense as soon as we find out. Right? So we go through this kind of waterfall of, hey, is the contingent liability contingent meaning is the future triggering event remote likelihood, very low likelihood? Is it possible? Is there a chance? Or is there a strong likelihood? And as we go up the likelihoods, we escalate to the investors, right? If it goes to possible, we're going to let the investors know like, hey, there's a chance of this happening. If it's very likely, we're going to try to give them a dollar amount if it's possible to figure it out. And so this is really potential legal claims where you see it, or if there's like debt guarantees. So if we promise an amount, normally a future promised amount of money if something goes wrong. And so they're talking here about environmental liabilities. And so we're saying the company estimates, so the following legal claims exist for a company. Identify the accounting treatment for each. A, the company estimates that a pending lawsuit could result in damages of $500,000. It is reasonably possible for the plaintiff will win the case. So since this is reasonably estimated, but not a probable, it's just possible, right? Like there's a lower probability of it happening. We'll just disclose the information, but we're not going to put the dollar amount on the financial statements. The company faces a probable loss on a pending lawsuit, but we can't estimate it. We just don't know. We're not going to, we'll say that it's on the financial statements. We'll say, hey, we have this probable loss, but we don't know what it is. And then the last piece, we have a probable loss. That's $900,000. We'll put that on our financial statements as an expense and a liability. Any questions here? And so I work with attorneys all the time. And in this situation, in this situation, like I have to ask the attorneys for their expertise, right? I would go to the lawyer and say, tell me about all your lawsuits. Tell me like the likelihood of them going to court, and tell me the likelihood of us owing money for it and how much that would be.
Professor, I have a question about possible contingent liabilities, right? So it's like if it's probably going to happen and you can't estimate it, so you just say it might happen, but you don't know how much. That makes sense. But why is it that you're not required to try and estimate for a possible liability?
The reason is we're already, as accountants, we're trying to make more firm estimates, and there's arguments, right? When we go into that territory, there's also possible revenue. There's a lot of different possibilities that can happen, but we're trying to only make assertions when we have certainty. And so this probable threshold is very high. Like we're very certain that we're going to owe a certain amount. While possible, the end of the day, our goal as accountants is to give relevant information to shareholders and investors and debtors, right? Anyone who's reading the financial statement users. And so we're supposed to do that in a cost-effective way. And so if we go invest every possible occurrence in the future, it's really not that cost effective, and it might not be that valuable to investors. But probable and certain events are definitely valuable to investors. And then also think about it like that financial statement. If an investor is interested, let's say we have a possible liability and it's on the financial statement, like the investor or the owner or the debtor will read it, and then they can ask about more, like if they want, right? That's their right. But at least we're informing them of it, and then we're saying we haven't figured out in a dollar value, but we're letting you know this is here and it could occur. And so at least they're informed and they know that they can investigate it further if they want to. Does that make sense?
Yeah, so basically it's just down to it's not that important, so we just don't put in that much effort to figure it out. Is that what it is?
Yeah, I mean, it goes down to the cost effectiveness of our work, where if it's not certain, we still need to educate investors and we need to educate financial statement users, but we can't go and spend all of our time investigating every possibility.
Okay, yeah, that makes sense. Thank you.
No problem. Yeah, it's this cost benefit trade-off, and it's pretty hard. Like that's where judgment comes in. I always wondered in college, like you'll hear this term professional judgment a lot, and that's where the judgment comes in. Like, where do you draw the line between probable and possible? Like if you go to a lawyer, he's not going to tell you like, hey, are you 90% sure this is going to happen? That's not a reasonable as you never ask someone like, hey, are you 80% sure it's going to be a good day today? You're like, people don't think that way. And so that's where you have to use judgment of, hey, really, should I upgrade this to probable? Like, is this very likely to happen? And you kind of use your historical experience and you ask experts and you try to get to a conclusion. There's this gray area. And that's why these are the kind of areas where computers can't automate us, right? There's not like some algorithm that determines the likelihood of a lawsuit going through and the amount, right? We have to use our professional judgment because human relationships are complex. And this is where this is why accounting is a valuable field. So good. I mean, excellent question. Any other questions? Oh yeah, I see. You only record if there's a lawsuit. No, you record if the lawsuit is probable to result in an amount owed. If there's a lawsuit pending, and it could be prior to a lawsuit, if we know we've infringed on a right and there isn't a lawsuit yet, but we expect one, we can also record it. It's just the contingency if we expect there to be a future triggering event. That was a good question. Any other questions? So if you're ever interested in law, like if you wanted to be a lawyer, I highly recommend accounting is like a good first. You can go to like business law school as an undergraduate, or you can go become an accountant and then become an attorney, or you could just be an accountant and work with attorneys like I do and work in contracting. But there you do a lot of legal work as an accountant. You read a lot of contracts, so you do a lot of business law work as an accountant. So and you go to 3 years less of school, so it's definitely not a bad choice or bad direction if you're interested in this kind of stuff. Any other questions?
So you're saying if you get a degree in accounting that you could also be an attorney?
Yeah, if you get a degree I know a lot of people who got a degree in accounting, became a CPA, and then went to law school afterwards. Not a problem. That's actually preferred for a lot of law schools, other than like another type of degree. they look for, a lot of lawyers struggle with like quantitative or dollars and cents assessments, and they look for people with that business expertise. So I think it'd give you an advantage to get into law school if you had an accounting undergraduate degree. And for me, I work with attorneys in negotiations all the time and make recommendations on contract law. So it's something that like I feel like if I got a law degree, it wouldn't change my pay and I wouldn't change my work drastically. Like I'd work in a lot of legal terms. If I got a law degree, I could represent people in court after I passed the bar. That's about the only thing that would offer me. Does that make sense?
Yeah.
Cool. Yeah. There's a lot of cool stuff in accounting. Like you can go work for the FBI and investigate fraud claims for top criminals. So I mean, there's a lot of interesting. You could just do like the tax stuff. Like I have friends that do that, and it's lucrative and it's good work because you're helping individuals and small businesses. But there's so many other careers you can go into too. Last piece, we're going to talk about this ratio. I'm just going to talk about it. I'm not going to do the ratio for you. We know ratios. You can divide by this point. So time interest earned, what we're talking about is income before interest and income taxes divided by interest expense. So it's really just a multiple. We're saying how much more money do we have we earned than our interest expense? And so it should be greater than 1, right? If our interest expense is higher than the money we make, we're in trouble. So that could be like, if I've met people who their credit card interest and their student loans and all of that is higher than their income, then you're in trouble, right? Then that's where you kind of start declaring bankruptcy, or you have to really figure out restructuring your debt. You get in a lot of trouble at that point. So we're trying to see here, that's just a way to assess companies, is you take their sales, you take their net income, and your income before interest expense. So you take this 150 divided by 90, and you kind of get a ratio. So that ratio would help us determine if the company is doing well or not. It's just another ratio to see how much money do they have left over, or how much money they earn based off the interest expense. And then you can compare companies and see how well they're doing or how well they're leveraging their debt. I'm not going to ask you to do this last part. Just ignore it. I think that you've covered too much payroll, and it's already very complex. We've gone over this in detail, how to do that journal entries, but ignore this for your studies. I'm not going to test you on like the IRS forms and whatnot. If you go into accounting, you're going to have to study tax law and learn this stuff anyways. And personally, it wasn't my favorite thing to do. So I'm not going to ask you to do it. But if you're interested in it, you'll learn this in tax law. That's it for today's lecture. I mean, I'll stop recording. We can talk about, let me